Now, last week's budget or financial statement, call it what you will, and the changes to the dividend tax rules that are coming in April will mean that many people who have shares or unit trust investments, open-ended investment companies who currently don't have to pay tax will have to start, and therefore they'll have to complete a tax return. Interest rates have risen too, whether that's caused by world economic conditions. Our previous Prime Minister or the current Chancellor, decide as you wish, but the rise in rates is going to take a lot more people into the clutches of the HMRC's annual torture of completing a tax return. And this has been rather less trailed than perhaps the rise in dividend rates. Because if you have more than around 50,000 in the average instant access account, which is paying maybe 2.5%, or 25,000, let's say, in a decent fixed rate account, where you can get perhaps 4.5%, you'll be earning more than the £1,000 of interest that you're allowed to earn before you pay tax, and that's just £500 if you're a high rate taxpayer. So that means you'll have to declare it and fill in a tax return. Now this, once again, is going to sneak up on a lot of people. It's going to cause more than a little stress, I think, for the conscientious members of the population. Cash ISAs, which when interest rates were paying next to nothing, weren't really worth the bother, now are worth having. But remember, despite current appearances, stocks and shares do and will once again rise to the occasion and still be the best place to invest if you want to beat inflation, which even with interest rates at 4% is going to mean the value of your money decreasing by about 5% each year. So keep the faith and keep investing if you can afford to do it.